afternoon, good people. This property here, it's like looking at your Rolex watch or closing the door of a Ferrari.
I've been studying the market here for a good number of years, and I've never seen this perfect storm of issues coming together.
So, ladies and gentlemen, it's up to you to be the king and queen of all you survey here. Beautiful part of the world.
We've got very high household debt, we've got very high house prices, we've got households in some degree of difficulty already now.
I'm looking for an opening bid. Where do we say go?
I don't know when we get a downturn that pops this, but as sure as hell, one's coming.
Hello and welcome to Four Corners. For the banks, regulators, politicians and for the public, it's the stuff of nightmares. What happens if Australia's debt-fuelled housing boom comes to a crashing end? It happened in Ireland, in Spain and of course in the US, with disastrous long-term consequences for millions of people. Australians carry the second highest level of household debt in the world. Many economists and market analysts say a correction is now inevitable. While the regulators have recently forced banks to tighten up on lending, experts in tonight's programme say the legacy of loose, irresponsible lending has many years to run. Four Corners travelled across the country from Queensland to Western Australia to understand the day-to-day experience for those people on the edge of the precipice, the growing number of Australians living with mortgage stress. Michael Brissenden's story begins on the fringes of Western Sydney, where faith in the resilience of the market is unshaken.
Prime Minister, arguably we're headed for a housing catastrophe. Tens of thousands of people could lose their houses if this happens, and people are struggling to pay mortgages.
What everyone should do is be careful. Yeah?
It's time for caution.
It is time to be prudent in terms of managing your financial affairs and make sure you do everything you can to live within your means.
Even as a young child, my parents would always take me to a block of land and my dad would say, oh yeah, we need to build a house here, someone's going to buy it. And the saying he had was, the land's owned by God and so it'll always do well. And they're not making any more land.
Australia's decades-long housing obsession has driven us here, to a subdivision on Sydney's urban fringe, 50 kilometres from the CBD. Before long, this paddock will be transformed. 21 separate lots, 4-bedroom houses on 600-metre blocks that could sell for $850,000.
This will do well. Anyone who's owned property in, say, Sydney, Melbourne or even Brisbane have made money just by owning properties. The best thing is, when I look at it, is we are still at the beginning. I mean, we have so much land, and fine, we're at the edge of Blue Mountains, and if population keeps growing, we'll go to the other side of Blue Mountains and we'll keep continuing.
Property has made Zaki Amir a wealthy man. From a humble start as an immigrant from Sri Lanka, he started buying property 10 years ago. Within 3 years, he had 15 properties. He's now got 25. Zaki Amir has surfed the wave of the biggest property boom we've ever seen.
The houses I was buying out in the western suburbs of Sydney, they were probably not the best areas, you know, around Mount Druitt, but those properties have more than doubled in value, and the areas are now part of home, part of lifestyle. And the properties there are selling for more than $1.1 million already.
But there's a growing chorus of opinion that says the dream run is about to end.
Price-to-income ratios are very high in Australia relative to other countries in the world. And if you're looking at New York, San Francisco, for example, Sydney is much more expensive on a price-to-income ratio. Now, Sydney's a wonderful city, right? But should people in Rudy Hill, Mount Druitt, and Blacktown be paying sort of higher multiples than people are paying in Silicon Valley on a price-to-income? It makes no sense.
Housing has never been rational. In Australia, it's probably more akin to a religion or a cult. So it's all about faith. So you're either a believer in property or you're not.
Buyers, terrific home we have the pleasure of offering to you today. The weather is so good here, clouds don't even turn up. You've got your own weather systems in Guildford. It is just simply a wonderful...
Guildford is a working-class Western Sydney suburb. Today, auctioneer Leon Axford is working his magic,
Opening offer.
pushing to get the best result he can for his retiring vendors and their small family home.
800. We'll start there. So I just see your card if I can to confirm. That'd have been 800,000, and I wish you the very best.
The opening bid is a strong one, but no surprise to those who've come to bid or just to watch.
That'd have been 40.
This month, the average house price in Guildford hit nearly $850,000.
And two of you in it. We joust for the keys at 875.
I do think that there is a bit of a frenzy about how do I get my property if I'm not already in the market. There definitely is a frenzy about that. Or how do I get my investment property if I've already got a house to live in? There is a frenzy.
880. 880. Good move, sir. Going to sell at 880,000. Once, twice, third and final at 880. Welcome to the neighbourhood, sir. Sold. Congratulations. Well bought.
This house is an example of how heavily we've invested in the dream of home ownership and where it's taken us as a nation. Australia's household debt is now second highest in the world, just behind Switzerland, almost twice that of the United States. For every $1 earned, Australians on average have nearly $2 of debt. And while debt has been increasing, wages and incomes have remained relatively static. In 2008, the Reserve Bank cash rate was 7.25%. Today, it's just 1.5%. But even with interest rates at historic lows, Australian households are stretched like never before. Our national obsession with housing, not just as a place to live, but as a driver of wealth and investment, has left us exposed and vulnerable to any external financial shock or even small cost of living increases.
Well, I've been studying the market here for a good number of years, and I've never seen this perfect storm of issues coming together. We've got very high household debt, we've got very high house prices, we've got households in some degree of difficulty already now. And so it doesn't take much to see the tipping point such that then we get this sort of downward spiral. And boy, if it goes, it could be as bad as Ireland or the US.
The rise in household debt has left the banks deeply exposed in the event of any downturn.
I think the vulnerability comes from the fact that 60% of their loan assets are actually directly to housing. Now, to give you an idea, one of the biggest housing bubbles probably in the world, people think, is in Hong Kong, but the Hong Kong banks have only got exposure to the housing market of around 15%. So if there is a downturn, then obviously the losses will build up quite quickly because so much of your portfolio is in this one basket.
60% of the Australian banks' loan exposures to mortgages. Is that too much? Should people be concerned about that? Are you concerned about that?
Well, ANZ's share of that is a little bit lower than the average, but no, I think that's actually not a healthy... it is a healthy mix at about 60%. The reality is that housing loans are pretty good because they're quite diverse in terms of lots of relatively small loans across the country.
Most bank CEOs were reluctant to speak to Four Corners. ANZ chief Shane Elliott did agree to an interview, aware that he was putting himself up as the face of Australian banking. So it doesn't make the banks vulnerable should there be any housing downturn, given that, you know, more than half of your exposures to housing mortgages?
Well, that would depend on what the nature of a downturn was. Of course, it's something that we look at incredibly seriously because it's in our best interest to make sure that our risk is well managed. So we look at the diversification of that book to make sure that people, when they do take out a home loan, that they're well prepared to be able to afford that in most circumstances.
This exposure to mortgage risk has already caused some reassessments. In June, Moody's downgraded Australia's banks.
Now, I guess some of our concerns are around the fact that you've got households holding more debt. That potentially makes them more vulnerable to a change in their circumstances. And if there's a shock to the economy, that potentially leads to a rise in sensitivity to the banking sector. So the banks could, in fact, experience higher losses because households are more indebted.
Jonathan Tepper is one investment fund advisor who's been sounding the alarm about Australia's housing market longer than most. He's an American based in London and a man with an international perspective. He called out the Spanish housing collapse before it happened.
All bubbles really depend on loose credit, and that's one of the things that's really fueled the Australian housing market, is that anyone with a pulse could essentially get a mortgage. I actually love Australia and Australians, and nothing but wonderful things to say about them. All I'm telling you is that this looks very much like previous housing bubbles, right? And I go back to the analogy that I always use, which is insiders versus outsiders, right? If you're the insider, you're like the frog in the frying pan. The temperature's been turned up very slowly on you. If you're an outsider, you might say, do you know what? That looks a bit too hot. And I'm just the outsider sitting there telling people that the temperature has been turned up.
There have been a number of Australian market analysts waving the red flag too.
Well, I think it's a powder keg is the short answer, and the problem is that for 25 years we've had this increased willingness and ability, tax enhanced, to leverage up to buy houses, and what we're left with now is clearly a massive affordability problem. But more importantly, I'd argue it's a huge policy problem, because if we were to have a downturn, it would hugely exacerbate the pain associated with it, and it makes it much more difficult for policymakers to control the economy.
Gerard Minack is another market analyst who's been accused of crying wolf, but he thinks he's close to being proved right.
Timing is always difficult, as they say about bubbles in financial markets. You've either got the choice of looking like a fool before it pops or a choice of looking after it pops. It's difficult to time them. I don't know when we get a downturn that pops this, but as sure as hell, one's coming.
From his penthouse on the 78th floor, Harry Triguboff has a good view of the impact he's had on the Sydney skyline and the nation's housing stock. Australia's biggest developer dismisses talk of a downturn. Triguboff's company, Meriton, manages 6,000 properties and is currently building another 11,000. What do you say then to people who... I mean, there's a lot of people talking about we've reached the top of the market, that it's overvalued, that there's a potential big downturn. What do you say to those people?
I say to them, I don't think it's overvalued. Because if you buy the land at today's prices and you build, then that's what you should charge. So it's not overvalued. Now, if they ask me if it's going to go up, I'll say in the immediate future, I can't see it. If they'll ask me if it'll go down, maybe a little bit. There's no rule which says that real estate must go up every year, by the way. So it went down a bit. It's not so terrible.
But the view isn't nearly as optimistic on Australia's west coast, even though here in Perth, people have also been betting big on housing.
Well, good afternoon, good people. This is where life really does represent people's Facebook profiles, doesn't it? Every time you come home to this property here, it's like looking at your Rolex watch or closing the door of a Ferrari. It just has that beautiful feel to it. That's what we're looking for.
The mining downturn has hit hard here, but Western Australia is an example of what can happen to property when a highly leveraged economy gets hit with an unexpected economic shock.
So, ladies and gentlemen, it's up to you to be the king and queen of all you survey here, this beautiful part of the world. Ladies and gentlemen, and in your hands, and we're looking for an opening bid. What do I say, Alistair? Where do we say go? All fired up, looking for an opening bid.
2 years ago, this house sold for $2.6 million. Today, WA's award-winning auctioneer is having a hard time getting a bid.
Can I suggest somewhere around 1.6 million to start off and get underway? Somewhere there, I would have thought. Someone help an auctioneer out shortly. Can I say 1.6 anywhere? I know we've got buyers here looking to buy. 1.6 anywhere. Now's your time. Thank you, sir. Sir, wait on that.
People are anxious. You know, people who are owning property, and if you'd invested in property in Perth, if you'd bought 10 years ago as an investor, you'd be thinking perhaps why you did that.
We're going to formally pass the property in, and may I say to you all, thanks very much for nothing. But it's nice to have hosted you regardless. Have a good weekend. Cheers. Thanks.
For a long, long time, generation after generation, not that long ago, we were very used to people's values of their property asset doubling each between 7 and 10 years each and every year in the major capital cities in Australia. And that hasn't happened in Perth. In the last decade, prices are back to where they were. I really appreciate that.
So household incomes are very much compressed in WA now. Many people are suddenly out of work or have got much lower paid jobs than they thought. And it's that sort of disruption that's really triggered it. But the net impact at the moment is very significantly negative. And if you look at some of the lender mortgage insurers and if you look at some of the banks, they've got pretty much double the losses now in WA compared with other states.
The Perth market has dropped 6% in the past 2 years. Outside Perth, the slump has been even more dramatic. I'm on the road to Mandurah, about an hour's drive south of Perth. A few years ago, it was seen as the perfect place to invest in the Australian housing dream. Now it's an example of how quickly things can change and how easily it can all go wrong. Today in Mandurah, there are more households at risk of default than anywhere else in the country. When you come here now, when you do drive into Mandurah now, what are you thinking?
Well, it's a sinking feeling for us because, it reminds us of the enormous debt we have and the burden that we're carrying constantly. You can't get away from it. And so we don't like coming into Mandurah, which really is a beautiful environment, because we're hit in the face with what we owe. And that's our reality.
In 2006, Tim and Lynn Kaler were convinced by a mortgage broker to use the equity in a number of properties, including their own home, to expand their property portfolio. But their investments are now worth half what they paid for them. And if they can't sell and settle their debts, the banks will repossess all of their properties, including the family home.
You constantly look at, the bank statements that are coming in, and it's absolutely terrifying. It's not a nice situation to be in at all. Especially when you've worked all your life, you've tried to pay your taxes, you've tried to put money away, you've raised your kids, and also you want to leave something for the next generation, and we can't do that.
At times you just have to ignore things and try to find something that's, a bit more pleasant for a few hours.
But it is the nightmare that you live with all the time. You wake up in the morning and you think, how much longer will we be living here? Constantly. And that is the most awful burden when, you're supposed to go home to safety. We don't go home to safety. We worry about the knock on the door with the bailiff coming.
But it's not just investors feeling the crunch in the West. Mandurah is one of the top postcodes in the nation for homeowners suffering mortgage stress. 1,500 households are struggling to meet their repayments, and more than 380 households here are at risk of default in the next 12 months.
You only need a small consequential change, a small increase in cost of fuel and stuff, to be able to actually really create that pain point. There are a good number of households who are really up against it now.
Martin North conducts a continuous survey that maps the financial profile of individual households, their spending behaviours and their motivations. His research can identify mortgage stress at a postcode level. Mortgage stress is a growing national problem.
It obviously varies by household, so we can run some scenarios. Let's assume interest rates went up by 1%, which is still below its long-term trend, right? So we go from 800,000 to nearly 1 million households in some degree of mortgage stress. So another 200,000 would effectively fall into that category. If you think of it in sort of weekly cash terms, you know, if you said, I've got to find another $100, you've got the 800,000 who are in difficulty now. There's another 250,000 who would also probably fall into the category of, you know, being tipped over. So we're at a very sensitive point in the cycle here, and only small changes in interest rates or small changes in cash flow could put more households into a significantly adverse position.
The remarkable thing now is that anybody has mortgage stress when you think that we've had 25 years without a recession. We've got unemployment that's not at a cycle low, but is relatively low by historical standards. And of course, we have interest rates at rock bottom low levels. Now, if you're under stress with that combination of factors, and we know there are a lot of people under stress, it can't get better. And that gets to the risk if you have a downturn. If you have a downturn and people lose their jobs, it almost becomes irrelevant what happens to rates. If you have a mortgage of 5 or 6 times income, the RBA can cut all it wants. You're effectively toast if you lose your job, or the main breadwinner does. And that's the point of fragility that we're at now.
Butler, on the other side of Perth, is another financially stressed slice of suburbia. Nicole Anger and her family are just one of Martin North's statistics. Nicole's husband is a bricklayer who now can't get enough work as the construction industry stalls.
I thought we would nearly have our mortgage paid off by now. Yeah, but unfortunately, you know, things happen in your life that you don't plan. And this is where we are now.
They bought this house 7 years ago. They fell behind in their mortgage payments. The cost of living and rising power bills have stretched things even further. Nicole leaves the lights off.
We don't have the money for a budget. We live from day to day, don't have any savings. Everything we have, I'm paying per fortnight, something towards the electric, something towards the rates, water rates, just to keep that going. Sometimes I have my son say to me, you know, you don't buy anything good to eat, you know, so, and it is really stressful, and I find it really difficult because I'm worrying about it all the time, so I don't get much sleep. I'm worrying so much that sometimes I worry at work, you know, so it does take its toll on you.
Big pockets of mortgage stress are found all over the country. Many of the worst are in the outer suburbs of the big cities and in regional areas. The Sunshine Coast in Queensland is really stretched. 11 postcodes here are struggling. 1 in 4 households are in mortgage stress. In Nambour, 74 households are at risk of default in the next 12 months. When you're in that sort of stress, what happens?
You argue a lot.
Yeah.
You try and have a conversation about it, but you can't keep the emotion out of it.
No.
Kirti De Meyer bought a house in Nambour in 2007. She borrowed $240,000, even though she didn't have ongoing employment.
I believe I had about a 6-month contract. It was full-time, and I had been working consistently for 10 years, and that was the only thing that was taken into consideration when I got the loan.
So you think they should have looked more closely at your situation?
Yes, yes. In hindsight, they should have, yeah. Yeah, I thought I was doing a good thing, not renting anymore and investing in my future. But I didn't take into consideration myself that, you know, that anything could happen.
The repayments became difficult for Kirti and her husband Scott to meet, and they were forced to sell.
And then, yeah, you've got to try and balance everything out. So you rob Peter to pay Paul, and then next week you pay Paul but don't pay Peter, and it's It's all, yeah.
And you have to ask your family constantly, if you've got any family, to sort of help you out. And, you know, you feel like a leper constantly asking people to just give you a bit of emergency support just so you can get through and know that you're going to have a house next week.
Well, one week we did actually end up going to the Salvation Army and got emergency vouchers for the weekend, just so we had food for the week.
And it was the mortgage that put you in that situation.
Absolutely. Yeah.
So one of the ways people made banks more profitable, made them larger, was to make more loans. Now, there's no problems with that. But the real issue is the person you're lending to has to be able to pay you back. And the only way you can grow is basically find more and more borrowers. And so the temptation always is to stretch your standards of lending to basically go one step beyond people who can actually afford to pay you back.
A big part of the story about how we became so leveraged in Australia is the role of brokers, lenders and developers who encourage people to borrow way more than they can afford. Well, we're about to meet someone who's had exactly that experience. Hi, Carly.
Hi.
Nice to meet you.
You too, Michael. Please come in.
Thanks. In 2012, Carleen Stafford was convinced to borrow $445,000 to buy an investment property in Queensland.
I received an unsolicited phone call one night, and the first question was, did I own my own home? I said yes. Was I working? Yes. And I had a call from a developer, and he told me that they could help me get into an investment property that would assist me financially when I retired.
To do that, she used the equity in her almost paid-off home. Before the phone rang and this guy got you into this, how much did you owe on this?
$153.
What Carleen didn't know at the time was that even the bank's own estimates on her financial commitments left her with just $9.17 at the end of each month.
The broker filled in the application for the bank, and actually on the form it says for the customer to fill that in, and I never filled it in. He filled it all in. He just got me to sign it afterwards. And there's a little box on there on one page too that said, was there any reason, or could there be anything that would that change financially coming up? And one of the questions was impending retirement sort of thing. And he never ticked that either.
Carleen has never been able to get enough rent from the property to cover the repayments. She's now being forced to sell her investment property, and the bank will repossess her own house when she dies.
You know, according to the developer, it was risk-free for me. Was the only people that it was a risk-free for was for the banks, for the ANZ Bank. You know, they've got nothing to lose. They've got the house up there, they've got my house here if necessary, or they've got, you know, a couple of $100,000 to be paid back once I sell this or die. So that goes out of my kids' inheritance.
When you look back on it now, do you think maybe you were a bit naive?
Absolutely. I was gullible, you know, I was sucked in. It just sounded so good. I mean, because as a female, that I didn't have a lot of super, still don't, and I thought it was going to top that up a bit because I'd only have a pension. You feel stupid. You feel absolutely stupid that you've been taken in like this.
Knowing what you know about that, should she have been lent $450,000?
So I can't really speak about an individual case here. I don't think it's appropriate in this case, but I will say I have spoken to this customer. In fact, I spoke to her just last week, and I've arranged to go and see her to understand a little bit and hear it directly from her so that we can learn in terms of this case.
ANZ defends the calculations used to assess Carlene's ability to repay the loan.
The reality is that when customers come to us, we do a thorough due diligence on their ability to repay their loan and that they understand the risks that they are taking. As I said, that's totally in our interest.
Someone once told me bank's a four-letter word, and it definitely is. And I think there's a lot of greed.
Philip Dempsey works in the finance industry. He was a mortgage broker for 25 years. He left in 2013 after growing increasingly uncomfortable with the commission-only payment system.
Look, there'll be targets around providing arbitrary number $2.5 million, $3 million worth of lending a month, which you probably need to write as a commission-only broker in order to survive financially, put food on your table. But when that pressure's on every month, and then there are cross-sale promotions and cross-sale requirements for insurances and the like, that'll also come into play.
And what happens if you don't meet those targets?
Transitioned out of the industry, basically. You just don't, you don't cut it, you can't make it, you can't survive financially. So there are some serious issues for the brokers.
So there have been brokers have knowingly lent people too much money when they shouldn't have?
Yes, there have definitely been cases where brokers have lent more money or encouraged people to apply for more money than they can comfortably afford to repay. Yes.
And why would they do that?
There'd be a variety of reasons, but one of the bottom lines is that's how they're paid. So the more dollars they lend, the more they get paid. So there's that immediate need to fill your own financial requirements, and it's very difficult sometimes. The lines can become blurred as to what's right for the client or right for me.
An industry standard for borrowing used to be between 3 and 4 times the amount of combined gross income. Today, it's now double that. So what would you say the standard is now?
Yeah, I'd say 7.5, 8 times without, yeah, in a lot of cases, yes.
So if someone came to you and said, we need to borrow 7.5, 8 times, that's not a big deal for most brokers.
Well, no, and it's encouraging to the broker too, because they get paid a commission, they're going to get paid a commission on more dollars lent, not on more clients seen, just on more dollars lent.
There are rogue brokers out there. There's rogue in any industry, but there's definitely rogue brokers out there, because you get an industry that's growing really fast and there's money to be made, it's going to attract, on the odd occasion, the wrong type of people. So there hasn't been a preponderance of fraud, but there has been an increase, I would say, of cowboy type mentality. Look, I can get into this industry and I can make quick buck and get out of it.
Mark Bouris was the founder of Wizard Home Loans. These days he runs Yellow Brick Road, one of the biggest mortgage broking firms in the country.
55% of every mortgage that's delivered to the system in this country comes out of a broker or a third party, not a bank. But on the flip side of that, at the end of the day, the banks are the ones that do the approval. The brokers don't. The only way where it is a problem is if the broker actually fraudulently fills out the forms or negligently fills out the forms. But the banks are pretty tough now. They just don't accept everything just because you put it there in writing or fill out the fields on the electronic application.
Incentive payments and lending targets are also endemic within the banks themselves. Four Corners has obtained Westpac's internal performance expectations for bank lenders. These include 6 to 9 home loan requests completed per week. If targets are exceeded, bank staff can earn bonuses of over $6,000 per quarter. It's not just staff selling home loans who have targets, their managers do too. We've spoken off camera to a number of former and current bank employees who say if they don't meet their lending targets, they're performance managed out of the bank. Okay, this goes to all the big banks have performance targets.
People get bonuses for good customer outcomes. So again, we measure every branch Every week, we measure something called a Net Promoter Score, which basically is a way of saying all the customers that had an interaction with that branch that week, how did they feel about it? If we do the wrong thing by those people or they feel pressured to buy something, I can tell you those scores go down. So we're absolutely paying people for the right thing, which is do customers feel that they got good service, they got an empathetic ear and they got given the right advice.
Even the banking regulators admit lending has been too loose. In 2014, APRA, the Australian Prudential Regulation Authority, began examining interest-only loans to investors. Earlier this year, APRA moved to further limit interest-only lending. APRA is now forcing banks to assess new borrowers' capacity to repay at interest rates at 7%. The regulators have asked the banks to tighten up their lending criteria. Presumably that is a recognition in itself that lending had been too loose up to that point, or that they thought that it had. Do you believe that lending had been loose?
No, I don't, and I don't know that it is a recognition of that. I mean, I think it's a recognition...
Well, why would they do it if they didn't think
Well, I think it shows that the system works. You know, as a bank, we only know what we know. We know about our portfolio and about our customers. The regulator's in a unique position. They have all the data for the whole market, and so they have a different perspective. The system works well when banks act in their own best interest of their customers, and the regulator puts in rules and guidelines to kind of manage the macro outlook. That's why the system works.
It's the loans approved before the tightening that are causing the problems. Some believe the loan tightening has been too little and too late.
So we've got a real big sleeping problem in the mortgage portfolio. If the underwriting standards were looser, and so people got bigger loans then compared with now, that means they're literally underwater now. It's not surprising that a lot of the mortgage stress that we have are from households in 2012, 13, 14, when in fact things were much looser.
The only issue is how long is the fuse? When the fuse burns down, I'm not sure when that happens. The fact that we have very indebted households with very high house prices will, I think, hugely exacerbate the downturn when it comes.
But despite the stricter loan environment, banks are still lending for investment and investors are still betting on property.
Everybody can do it,
Yeah.
That's the thing. And if we can do it, and I feel like a little bit like Beavis and Butthead, when anybody can do it.
In just 2 years, Roy Pallison and Rowena Ibona have bought 7 properties. They've done it by leveraging more debt against the rising value of their investments. Do you mind if I ask, how much debt are you carrying then?
Currently 1.2.
1.2, yeah.
1.2 across the 5 established properties. For the 2 land and build developments, they haven't registered yet. So when that comes, then that'll increase. Yeah. And their market value, if we were to just close up and sell all of them, would be around 1.5 in today's market.
A little bit higher. That's conservative thinking.
I'm conservative.
But yeah.
How much do you both earn?
I earn about 60,000 a year.
I'm 75 grand a year. Yeah. So average.
These young speculators don't even own the flat they live in, but they see property as the best way to build a secure financial future. They're dreaming big. So how many properties do you think you'll end up with?
Probably around 20 initially.
Our goal is 20 initially.
That's our primary goal, to get to 20.
Where are you going to be in a few years' time if things keep going the way they're going?
Pina colada.
The question being asked now, though, by many is if there is a downturn, how bad will it be?
I read what all the commentators say, and I look at all these sort of hairy, sort of could-be type scenarios, and I have to say they do give me sleepless nights sometimes. I do sit up thinking about them. But I always revert back to the 2 regulatory environments, the Reserve Bank and the APRA, and I think they're doing a very good job. So far, so good. Who knows what's going to happen, though?
I don't think that we've over-leveraged Australia. As I said, there's a total alignment of interest here. The banks absolutely want to do the right thing because it's in our interest. We don't want to lend to people who get themselves into difficulty, because then we get into difficulty. So we have a responsibility, and it's just prudent for us to do a lot of due diligence to make sure that people can afford the debt that they're taking on. Does that mean that there aren't concerns, that we shouldn't always be looking at possible risks? Of course. You know, it's a risky industry that we're in by the nature of banking. That is what we get paid to do.
I think it will be determined by what happens to interest rates, what happens to incomes, household incomes, and whether in fact households are able to keep that sort of leaden weight of debt at bay for long enough. I'm coming more to the conclusion, though, that it is unlikely to unwind in an orderly fashion, and therefore perhaps we will see some disorder in the market in the next couple of years.
And what I would argue is, looking at Australia with a household debt to income ratio of 190%, so almost for every $1 of household income, there's $2 of debt. I cannot think of a single economy that's had a downturn with that much debt when it's not been a deep downturn.
Despite the warnings, most Australians are still hoping their faith in property will be rewarded. But for some, the dream has already turned sour.
It's become a nightmare. Yeah. There's so much, just the struggle. Yeah, the struggling. It's not living. You're not living. You're actually not enjoying life with having the struggle of trying to own your own home.
What do you think now about the whole idea of home ownership?
Oh, it's a nice pipe dream. Yeah, that's pretty much what it is, because I'm not sure if we'll ever achieve it again at the moment.
After we brought Carleen Stafford's case to the attention of the ANZ Bank, CEO Shane Elliott met her in Perth late last week. They've since reached an agreement on her debt, the terms of which are confidential. In a statement, the bank conceded Carleen was targeted by aggressive sales tactics by the broker and developer. You can see statements from ANZ and other banks on our website. And the story continues at ABC News Online, where we've mapped mortgage stress hotspots across Australia. You can also find out what the impact of a rate rise would be on your own suburb. Next week, the blood business, an investigation into the lucrative international trade in blood and plasma. See you then.